Welcome back to the Teslaverse. So today I'm going to show you my discounted cash flow model on Excel, which is tied with this presentation that I gave a while ago. So I'm just going to go over it really fast. You could actually go on my website and watch the video because there's a lot I have to say. Just a few things. If you remember first I said, what's going on with Tesla? I think we all know what's going on with Tesla. They're having a really, really hard time. Dan Ives is calling it an unmitigated disaster. Low car sales. No one's buying their cars. Not even the Chinese are selling more cars than them. That's referring to BYD. However, long-term car projections, EV car projections, are positive. Then I mentioned that Tesla has a strong position within the industry structure of automobiles. And I mentioned the lower cost, vertically integrated. And I mentioned how, for example, Ford is losing tons of money, like $1.6 billion in EBIT alone on the Model E. And then I mentioned in order for EV sales to go up, the price of EVs need to go down below ICE, meaning internal combustion engines. They got to go much lower than they are. And according to ARC, the addressable market goes way up once the price of the car, you could see here from left to right, when the price of a car goes down to around $25,000, the addressable market skyrockets. And that's where my Tesla model comes in, my discounted cash flow model. So before we talk about how to evaluate companies using discounted cash flow, there are other ways. There's a price to earnings. And what I like, my favorite is enterprise value to forward revenues. Why? Because you can value any company in any industry, even if the company is losing money. So it's very important you notice that. So one thing I said here, there's a lot to talk about. I could talk to an hour about this, of how or what this company is worth, based on what software companies are worth, what car companies are worth, what a premium car company is worth in S&P. But my point is using PE ratio, if you will, which I don't use. But if you look at the PE ratio, what I have on this table, the shares could go down 40% or more. And then I mentioned, the stock price, that it's down a lot, and it's $175 a share as I'm filming this, but it could go down to $100 based on the trend line here, but also based on what I mentioned earlier. The EV to revenue multiple is just too high. It's around 5.5. It could come down to 5. So what's my solution? It could come down to 2. So my solution is that if Tesla wants to sell more cars, they need to, like the title says here, they need to have an FSD subscription model, and the company needs to be dependent on the subscription model. They need or convert themselves, I should say, from being an old-fashioned type car maker, even though they're not we all know, you and me know, they're not an old-fashioned car maker, but the average investor thinks they're a car maker. But we need to convince them that they're electric vehicle / autonomous car maker. So in order to do that, I think what Tesla needs to do is lower the price of their cars, even if they're losing money on them. Okay, that's my key point. Make the cash flows from automobile production very low. Artificially suppress those cash flows. And I call them cash flow margins. That's free cash flow divided by revenues. Keep those margins low, but get your customers to adopt the full self-driving subscription model, because full self-driving, even though they cut it down 50%, it's $100 a month now, and $8,000 if you buy it for a lifetime membership. That's still subscription revenue, just like Spotify and Netflix. And investors love that. And it's very predictable. And it's going to give very high cash flow to Tesla. So let me see if there's anything else I want to discuss with you here, because I really want to talk to you about my discounted cash flow. Oh yeah, here's one important thing. This car is going to be the cheap car that sells for like $25,000 to $27,000. This is what's going to spur those auto sales. And then just one last thing to show you, to supporting my model, is this from McKinsey. It's shown that ADAS, or level 1 through 4 automotive driving software is going to skyrocket. So I have third-party evidence supporting my discounted cash flow model. That's about it. I guess lastly, I just want to show you this. The storage market, the battery storage market is going to soar. And this is in my model too. In my model, I mentioned how this is going to do really, really well. So let's get to my model because that's when I want to spend most of my time. I've already spent 5 minutes on this. So this is my Tesla model. This model has nearly a dozen business segments. Now, if you know Tesla, you know they only show 3 business segments. That's automotive, one, and number 2 is solar slash storage. That's battery storage. And the third one is basically other. It's like services and other. So that's all they show. But what I do is I show a whole bunch of revenue units. And maybe I'll go to the bottom and show them to you. Yeah, I'm going to go to the bottom here to show them to you, to show you what they look like. So it's right here. We got EV. I broke it up to EV car revenue, the truck revenue, which is coming online soon. So I included it in the Tesla core. And then we got the FSD revenue, which I mentioned to you, the subscription revenue. And then we've got insurance, charging, which we all saw on the news because of laying off people. The services, which is kind of like an other revenue. And then we have energy generation and storage, which I think is a key revenue driver for the company. So I guess we work backwards, but I really want to start with the top, the EVs. But let me just show you this for now. So Tesla did almost $96.8 billion in revenues in 23, and investors are analysts, I should say, are looking for about a 10 to 12% growth this year, which is year 1, 2024. I'm only looking for 2% growth. Then I'm looking for back to the reversion of the growth of the 20-something percent growth. And I'm looking for a lot of that growth, especially in cash flow, to come from FSD. So let's get started. I have a lot to talk about, so let me zoom to the top here. So the first thing I said I would talk to you is about Tesla's EV business. I even got market share here. So in 2023, Tesla had 13% market share. I know a lot of you hear that Tesla's market share is 50%, but that's usually US market share. This is global market share, and this is not market share of did I put electric vehicles? Yeah. I wanted to say this is total market share. Oh, wait a minute. I don't have that. I'm sorry. I thought I included total market share. No, this is 13% market share of global electric vehicles. I also have market share of total vehicles that includes hybrids, ICE, and purely electric. And that number is really high. That not market share, that unit sales is really high, like 75 million units, something like that. But I don't have it here in this table. So what I want to talk to you about is unit sales were 1.8 million in 2023, basically last year. And I've only got them going up a little this year. But I told you their strategy, and this is the key point of this presentation, their strategy is that their unit sales are going to go up rapidly because they're going to artificially suppress profits, also known as free cash flow margin, because you can show profitability in many ways. You can show EBITDA, EBIT, gross profit margin, net profit margin. I'm showing free cash flow margin for a few reasons, but the main reason is because I'm using it for my discounted cash flow model. So if you see in 2023, they had a 7% margin when the company was smaller than it's going to be in the next 10, 15 years. So you would think that a company that's very good at scaling and that is scaling rapidly and it's good at execution, you would expect this margin to at least double to 15%. I do not have that. Now, if we go to the right here, as we go to my projections, and they go out to 2038, I believe. Let's see. Yeah, 2038. I don't make my free cash flow margin go any higher than 4%. That's because they're going to keep the prices of the cars low. They're not going to make money on them. They're gonna make some money, but not much. They may even make this free cash flow margin as low as 1%, barely positive. But what they could do is lower the ASPs. You see, I've got average selling price of each unit, of each car, of only $22,000. That may actually go down to $15,000, believe it or not, 2038. And if you recall, ICE cars go up in value. This has never occurred. Cars especially because of inflation and monetary debasement. Cars go up in price every single year. But because of the technology DNA, I actually think that electric cars are going to go down in price and perhaps rapidly. And I said to you earlier, and this is my thesis, that Tesla is going to artificially suppress profit margins in its automobile unit so that it could have more automobiles, are basically a higher fleet size. I'm not sure if you know what a fleet means. That's the total number of Teslas. So it's not just the Teslas that are sold this year, but it could include like 90% of last year's Teslas and 80% of the previous years. There's a whole ratio too, because cars, they get into accidents, they get obsolete over time. So the fleet is never 100% of all the cars sold each year, basically. So again, I just want to go what I just said. I want to reiterate it, and then I want to go over some nuances. Number one, I've got Tesla's market share going up rapidly because they're lowering their prices. Number two, as I said, prices are coming down. And so because of that, unit sales are going to be going up again, starting in 2025. Oh yeah, one key point. 2026 is when I have that Project Redwood, I think it's called. Redwood or something like that, that $25,000 to $27,000. I always make it higher than they say it's going to be. They said 25K. It's probably going to be 27 because Elon Musk has issues with keeping timelines and promises on prices of cars. But the point is, average car price is going to go down dramatically in 2026 and 2027 because of the introduction of the cheaper car. And that's also going to help volumes of cars go up. And one last point is you can see I have a huge, and very few people have this, have a huge free cash flow drop from $5.5 billion last year to a $2.8 billion loss in the automobile industry units because of all the problems that Tesla has in 2024. So I don't want to take too much time because I've got a lot of units to talk about, like business units. So I may actually have to skip some of these. So let's do this one fast because I want to talk to you about FSD. The first one I'm talking about is trucking. Tesla has a pilot test with Pepsi, and I think they're going to start introducing trucks real soon. And I'm not going to focus on this too much. I just think that the truck's going to be $250,000, and then they're going to go down in price. And I'm not going to spend too much time on this because it's not going to be a big unit, at least for the first few years. So let's go to my main thesis, and that's full self-driving. So I told you, maybe I should tell you, full self-driving, especially now, is not fully autonomous driving. That's just the name of it. It's actually level 2, SAE level 2 ADAS, assisted driving. So just be aware of that. But if you look at the new full self-driving, because of the shift from a million lines of code, wherever it is, and heuristics to neural networks, meaning AI, because of the shift to AI, the car is being driven much better in its autonomous mode now than it used to be just a year ago. So we're making big progress. But going back to here, so this is where I think they're going to be a cash cow. So let's bring this up here so you can read it clearly by the year. So you can see the line 29. It's highlighted. You can see that's the Tesla fleet I have. Then I have an attach rate of 50%, and then slowly going up each year as it gets more and more popular. More people adopt this, and they're going to be paying $100 a month. They used to pay $200 a month. Now they're just going to be paying $100 a month. Now, one key point. I think there's going to be some third-party licensing, not for a while, but I just want you to be aware that if you're looking at this line, you're like, what does this mean, license unit? And over here it says licensing because 200. I think Tesla's going to be able to license to robo-taxi companies and to other OEM legacy car companies like Ford, General Motors, Volkswagen, Chrysler, GM, whatever. They're going to be able to license it. And of course, they're going to license the FSD at a higher price commercially, obviously, than they're going to do to their own customers. That's why I put $200 for license versus $100 a month for the customers. Now, the key point here is that free cash flow is already high and it's going to skyrocket. So you could see as the years go up, that free cash flow is going up rapidly. And I've got a very high free cash flow margin of 70%. So by 2035, we got free cash flow of $35 billion. So that's the best in business unit, obviously. Then we got, and I'm going to talk about this quickly, so part of the services business unit, we got Tesla insured cars. This is as a service to its customers. It's not going to make much money. I'm looking at this saying, why is it making so much money? This is because this is 2034, 2025. Let's go to the beginning here. So you see here I have negative free cash flows for quite a few years because insurance is done as a service to its customers, not because Tesla wants to be in the business. Speaking of wanting to be in the business, I'm not even sure if they want to be in the charging business, but I think charging is going to do really well because if you look here, at my industry data, there is a huge forecast for rapid growth in charging stations because we need charging stations. So I still have Tesla growing charging stations rapidly beginning in 2025. But this year, as you all know, there's mass layoffs in charging. And I'm not sure how profitable they are. So I have them at a cash flow loss. I really don't think they're making much money now, but they will because they're licensing their chargers to nearly every single legacy car maker. Again, like Ford, General Motors, but it's not just the big three. It's almost every car maker in the world. You can see my free cash flow margins are like low single digit negative. And one of my favorite business units is within energy generation and storage. It's basically energy storage, commercial. So let me go over this because it's a little complicated. So within the energy generation storage, we have energy generation, and that's basically, I believe it's just for the residential energy generation, meaning old-fashioned solar panels. It's funny I'm calling solar panels old-fashioned, but they are. And then there's something called a solar roof. It's a really hot-looking roof. You should check out the Tesla website. And this business also includes Elon Musk's cousin's business, the Solar City business that they acquired amongst much controversy. So I think this business will do okay. There's a lot of tax incentives. But what I'm really, really excited about is this, energy storage. And this is not only the Powerwall storage, and that's residential, but what it includes is the Megapack business. And this is a business I'm very, very excited about. This is like one of the most important and vital and cash flow positive businesses of the whole Tesla company. And you could see that I've got, where is it here? I've got the megawatt hours growing dramatically. And this is because it has. I'm not just pulling this out of thin air. I looked at industry forecast, number one, and you can see it's right here. This is an industry forecast, energy battery U.S. storage. And this is only U.S. And you can see it grew 36%, and it's growing 32 and 28 and 25. So this is proof of pudding. And let's say you don't want to look at that. You're just looking at Tesla's. Well, Tesla's energy storage business grew 125% in terms of megawatt hours. So this is real, actual growth. And then I've got average selling prices per kilowatt hour declining due to new technology. Because, technology is deflationary, as you should know. And then you could see the energy storage revenues right here. And as a background, energy packs store a huge amount of energy. I can't remember offhand. What is it? It's enough to power, I'm forgetting it now, a certain amount of homes per hour. Because you have to remember, it's confusing to relay energy packs with solar, because solar powers a house. The average house uses 5.2 kilowatts of energy per year, and it's tough to equivalate this in kilowatts. Here I have megawatts, but it's kilowatts per house with with energy storage because they use megawatt hours. Now, hours are not used when you're talking about solar energy production, so it's very confusing. There's a way of converting it. Basically, the mega packs are huge, and they could store a huge amount of energy, a lot of energy, backup energy. So they're not for consumer use. They're for like utilities, for energy grids. And there's a lot of use for them. And you just think about how much money you could save by not having to pay peak power. If you're not sure what peak power is, look it up because peak pricing is insane. It could go up like 1,000%. So you can see I have huge growth for the industry, not the industry, for the Tesla's overall energy generation and storage segment. I got it grown from 6 billion to 8.7 billion to 12.3 to 17. It's just growing rapidly. And then we've got other segments I'm not going to talk about. Something called Order Bidder. That's basically does like trading and arbitrage. And then I got new businesses, which we're not going to talk about today. But there's a whole bunch of new businesses that I'm looking at. So if you take all this in and you make a discounted cash flow of only the existing business, not the new businesses. I'm not including the robo-taxi or the robots or whatever. I'm just including, the business that we have now. If you do a discounted cash flow model, you could actually calculate what Tesla's shares are worth. But before we do that, I want to show you how I do this. I see mistakes every single time I look at someone's discounted cash flow model. So here, I'll tell you where the mistakes are made. The stock's beta, everyone puts a low beta like 1. And look at what happens to the WACC. The WACC here goes from from 10.4 down to 8.3. That's insane. And that's the problem. When you change these assumptions, the WACC changes. And when you change the WACC, even a little, it changes the whole value of what the company is worth. So you got to be really, really careful. And if you're not sure what number to put or what assumption, always be conservative. So I use a pretty high beta and a regular cost of debt. But I made sure my WACC was at least 9.5%. A lot of people use 8% WACCs, 9%. Just so you know, WACC is weighted average cost of capital, also known as discount rate. This rate should be higher than, I'd say at least 9.5 to 10%, but rates are high now. The short-term rate, for example, is 5%. And last 2 years ago, when were even longer-term rates were near zero, people were using like such crazy low rates. It's insane. They were using WACCs of like 6 to 7%, which is garbage. You know the saying, garbage in, garbage out. Other things I want to talk about is the terminal growth rate. Some people use 2%. It should be 3%. I'm sorry, I made a mistake. Yeah, some people use 2%. No, I did make a mistake. Some people use higher rates, like 4%, 5%. 4% for new company, maybe, but the industry standard is 3%. So just be aware that if you put like 5%, it throws off the whole valuation and makes it too high. And shares outstanding, you're supposed to include today's shares outstanding of 3.5 billion. But I'm trying to be conservative and to account for stock dilution, but I do not expect any capital raises, any equity offerings. This is just more what is it called? SBOS, stock compensation for Elon Musk, basically. I'm being more conservative. So here, maybe I'm too conservative. Maybe I should just make it 4 billion. But the point is, you're supposed to put today's shares outstanding. If you like, you can make it a little higher. And this is a net debt level. It's not a debt level. It's net debt. So if there's a lot of cash, you have to net out the debt level with the cash. And so if there's more cash, you make it negative. So after doing all that, I got a intrinsic value of $224 per share versus today's price is what? Let's see. Today's price, is 176.29. What did I have here? Wow, what a coincidence. I wrote this days ago. It's still the same price. So basically, I have the shares worth 28% more than they're trading today. Is that enough to say that the shares are undervalued? No, it's not enough. in my view. You might say 20% is a big difference, but in my view, it's not, because of what I said earlier. The assumptions can be over here, can be changed and manipulated. And that's just the ones over here. Then you can go over here and change all these assumptions for units sold, revenues, cash flow margins. It's so easy to make slight changes to these assumptions to affect the value of these discounted cash flow, and then the difference in valuations here. So what's my conclusion? I'm sorry to say that this is not enough. And what investors are going to do is what I said earlier. They're going to be looking at this. They're going to be looking at either the price to earnings ratio, or they're going to be looking at, maybe I can make this larger here. They're going to be looking at EV to revenues. And again, the bottom for Tesla in terms of enterprise value to revenues is 2 times. The S&P is trading nearly 3 times. And car companies trade around 0.9 to 1 time, 1.3 times. So if EV revenue valuations are so much lower than Tesla's trading around 5.5 times now. So if they're trading so much lower, you know it's going to trade between 1 time and 5.5. So you pick the number. My guess for the low valuation multiple is between 2 and 3. Why? Well, first of all, Tesla was there. Tesla actually was trading only at 2 times revenue multiples. And the S&P, which also includes non-tech those companies, I should say, they trade at 3 times. So I think 2 to 3 is reasonable. So if Tesla's trading at 5.5, you could do it this way with a calculator if you're confused with what I'm saying. If Tesla's trading at 5.5 times, and we're going to pick what, between 2 and 3? Let's pick 2.5. If they can trade as low as 2.5 times, that's 2.5, a multiple of 2.5 divided by where they're trading at now, something like 5.5. That's a 46%. They could be trading at 46% of what the shares are trading now. If you recall, the shares are trading at, where was that? Let's just find it again. Here, the shares are trading $176, right? So if they could trade at 45.5%, let's make this percent so it's clear. That's what I'm talking about. They could trade at 45% of where they were trading here. So you take that number. What did I do? It's not 111, it's 100. Let's do it again. 0.455, something like that. Now times 176. They can trade at as low as $80 a share. Will it go down to $80 a share? I doubt it. Why? Because there's a lot of support. If you go to 5 years ago, actually, if you only have to go here to December 22, they traded as low as $100. There's a lot of support here at $100. And there's support actually where we're trading now. So maybe they go between 155 and 100, something like that. So that's all, folks, for my presentation. I hope this was not confusing. Later on, I'm going to show you this presentation on Tesla if they had new businesses. Right here, you can see I clicked on that we're excluding new businesses. So if we include new businesses, the shares are worth much more. So I hope you enjoyed this, and thank you for listening to the Tesla Universe. And don't forget to like us and subscribe. Bye-bye.